Hi, Kelly Bullis, CPA here in Carson City with Toby once again. We're doing this series of preparing your business to sell someday. You know, the old saying is you're not going to live forever. Maybe your business will, maybe it won't, but someday you're going to have to figure out how to get out of the business and hopefully get enough money to help with your retirement plan. And so we've been talking about all kinds of things that go into preparing a business for sale. So you know what? We're finally getting where the rubber meets the road. We've been talking about increasing sales and having employees and not having the Switzerland structure where you're heavily dependent upon a key employee or key vendor or key supplier. We've talked about a lot of different things, and then we started to talk about working capital last time. And we used some ratios on your balance sheet to identify if you have too much working capital tied up in receivables and in inventory. Okay, now this week we're going to talk about the real king of all this, the cash flow.
Cash flow, that's right.
You know what? Somebody once said, you can show me anything in the world, but cash flow is king.
That's right.
Where's the rubber meet the road? How much is it spinning off in cash?
That's right.
And so let's go through a couple of examples maybe to understand what goes through the mind of a buyer when they're coming and looking at a business. What do they use for deciding is this a good deal or not? How much do they want to pay? So let's use a hypothetical situation. Let's say we've taken the business and we've got the financials that we've been keeping now for at least 3 years where we've moved all of the compensation for the owner down to the bottom of the financial statements so that we can show net income from operations before compensation of the key person, usually you, the owner of the business. So we're going to take your salary and your medical insurance and anything else that you built into the business that doesn't need to be there in order for the business to continue to run, because that really is your total compensation package. So we're going to move that down to the bottom. We're going to want to do that for at least 3 years so that we can show a trend of what is the net income from operations before compensation of the key person running the business.
Right.
And then, of course, whatever your compensation is, it can be higher or lower. What does the market say? Maybe you're taking $100,000 a year to run your business, but you could hire somebody else at $50,000 a year to do the same job you're doing. You're probably a little overpaid. You have the right to do that. It's your business.
That's right.
But a buyer's going to be looking at, what would I have to pay somebody to do your job since you're not going to be there anymore? So it's important to be able to separate that out. Another thing we like to separate out is all non-operating, non-cash type issues like depreciation or interest.
Interest expense.
So we take interest and depreciation, we put those down as well in the other income and expense section of your financial statement so that we have regular revenues from operations, your direct costs, and all of your selling and administration, and we get down to that number that we call income from operations, cash flow, and then we want to show at least 3 years of that so that we can demonstrate that this business has consistently produced a healthy number. Right. So let's say that number is $80,000 a year. Okay? And also, over the years, I've really bought a lot of really nice equipment. I buy the top of the line stuff. I don't buy anything cheap, and I've got about $1 million worth of equipment, fair market value, $1 million worth of equipment, and then I'm producing $80,000 a year out of the business, and that's after figuring out I would pay somebody else a reasonable salary to do my job. Okay, so I'm thinking, gee, I'm gonna get a really nice price for my business if I sold this to somebody. So what goes through the mind of a buyer when they see this?
Well, that number at the bottom, where we pushed everything down to the bottom, the owner's salary, his bonuses, his perks, his health insurance, and then the non-cash items depreciation, and then interest expense. We have a term for that portion of the cash flow from a business, and that's called the owner's discretionary cash flow. It's discretionary. He can change any one of those things at any time that he wants. And what we want to do is at least the last 3 years before you put your business on the market, is start turning as much of that into cash as you can in form of a bonus and stuff, and reduce the esoteric things, the perks and stuff, so we could see it as really was cash. So we move all that down. So now in the example you gave in small businesses, Small businesses tend to sell on an average in a range of, on the low end for a viable, profitable business, on the low end of about 1.5 times discretionary cash flow. On the high end, about 2.5, and the average is about 1.75 is about where the average is. Okay. But let's say that, for sake of keeping the arithmetic simple, that it's 2 times cash flow. So if you have discretionary cash flow of $80,000, and your industry tends to gravitate towards a multiple of 2, that means that that buyer will pay you, that business is worth to a buyer about $160,000.
Ouch!
Yeah.
So in other words, I really worked hard. I built up this baby as positive cash flow after, what it would take for me to run it, of $80,000 a year. And geez, I've got all this really great equipment. You're telling me that the average buyer would only pay me $160,000 to buy my business in a going concern capacity. In other words, it's an operating business, and I'm going to step out, and they're going to step in, and it keeps doing what it's doing. Only $160,000. Ouch.
The business, the value of a business as a going concern is a function of its cash flow, not its assets. Not its assets. Never its assets. It's a function of its cash flow. But we have $1 million in equipment.
Yeah.
So what does that mean? Well, then we change the premise of value from going concern to liquidation value. And in this scenario, we have a business that's said to be worth more dead than alive. And what that means is that you could sell this business for $160,000 as a going concern, or if that equipment truly is worth $1 million today, then you could shut that business down, pull that equipment out, put it out on the sidewalk, have a going out of business sale, sell your equipment and your inventory for $1 million and go away. That's what you need to do. So you have 2 options when you look to sell your business. You can sell it as a going concern, or you can liquidate the assets in a going out of business sale. And that second option is more common than you might think in small businesses.
Okay. Well, there you have it. Cash flow is king. It really does drive what you can sell your business for. We've talked about how to increase your sales, keep your costs down. That helps improve cash flow. We've talked about working capital and everything else, but what it really comes down to is you need to demonstrate over at least a 3-year period of time a really healthy cash flow for a buyer to come in and pay you the kind of price you're looking for.
And it has to be easy to identify. Yep. Stop burying stuff for at least 3 years, and ideally 5 years before you put your business on the market. Get it out there so we can see it on the financial statement.
Yep.
We can see it on the tax return.
Yep. So, if you have any questions, give us a call. We're going to go over some other topics later.
Yeah.
But we've been kind of building up to this, and you knew it was coming. It all comes down to what's your cash flow.
That's right.
And boy, that's a new one to remember. My business might be worth more dead than alive. Yeah. That would be painful to my ego if I built this up and I built a lot of happy customers and a lot of good employees. But when it comes down to it, my retirement fund is going to be maxed out as much as I can get for this business. And so I have to let go of my ego and sell it for the most that I can get. And maybe liquidating it is part of the plan. Just kind of know that up front, that there's no way I would ever be able to sell my business for a cash flow based prices and operating based prices to give me the money I was hoping to get out of it. So maybe running a business right up to where I close the doors. You see this happen all the time, going out of business sales. Obviously, they decided it was better to liquidate and close their business than to sell it as a going concern.
And one thing that we touched on this at the last presentation we did, but there's the in-between stage where you have equipment that you don't need. It's not necessary for the operation of your business. It just piles up and accumulates. It's in the back lot or somewhere.
Yeah. Don't need it.
You don't need it. Yeah. So the thing to do there is that equipment is not adding value to your business as a going concern. So the thing to do is sell that equipment for whatever you can get for it before you put your business on the market, because that's just going to be gravy on top of what you can get for the cash flow.
So in other words, if I had that $1 million worth of equipment and I could sell 800,000 of it and then still sell the business,
for 2 times
for 160,000,
Yeah,
I'm about at my million, and I
Yeah.
still feel good because the business is still going.
Yeah, well, sure,
Okay.
yeah.
Well, there you have it.
Okay.
We'll talk some more about some of these more topics next time. Thanks for watching.